Okay, let's go ahead and get started. I apologize with some Zoom issues there. I can't make this full screen. Otherwise, we run into a little bit of issues, but I do have the chat window up. So please let me know if you cannot see the screen. But nonetheless, today we're going to talk about technical analysis. We'll talk about the introduction of it. We'll go through how to use it and the tools that are available for you within First Trade's platform. And if you don't know me, my name is Jessica Inskip. I'm the Director of Education and Product over at Options Play. Really excited to be here. My job is to make sure that education is really bridged between any of the products that you touch because options can certainly be complex and not easy to understand. However, with the right foundation of financial literacy, we can give you those light bulb moments. And that is my job here at Options Play. Now, naturally, before we get started, we do have to give you a couple disclosures. We're not going to talk really about options today, but technical analysis. We'll give some input of how that can help with your options trading. But it's important to know that options are complex. They're not intended for everyone. There's a document that's called the options disclosure document that goes through the characteristics and risks of options trading that is issued by the OCC. You can find it on the OCC's website. There's also should be a link to it on First Trade's website. So that gives you all of the details of options trading. And it's important just that we show you that from a disclaimer perspective. And also know that there will be some securities discussed today. They're purely for informational and educational purposes only. They're screenshots from a snapshot in time, haven't gone through that due diligence. It's just purely to illustrate an example. So just for educational purposes only. And of course, anything said today is not intended for individual tax, legal, or investment planning advice. Options Play is a third party not affiliated with First Trade whatsoever. So anything that we say is not a reflection of First Trade as well. So now that we've gotten through the disclaimer part, let's talk about what we're going to discuss today. So first and foremost is the value of technical analysis. What is it? Why would we use it? What is the purpose? What's the crux behind it? If you've ever seen any of my work before, you know that technical analysis is something that I definitely use more often than not. How we layer that on with option strategies, both are comprised of a lot of math. We don't have to know the math, but it's important to consider it because it gets into the how and the why in the application process. So we'll definitely talk about that very briefly. Don't let me scare you away with the math. And then we'll talk about some price analysis and patterns, use some examples, chart overlays, so different type of technical indicators that you may or may not have seen before. We'll talk about momentum indicators and then perhaps save some time for Q&A. All right. So, talking about options and how this relates to it. So, normally when you're trading options, you tend to lean on either side depending on the strategy that you're selecting. And there are lots of option strategies that are available to you. However, you have to know your goal and your ideal outcome. And that's where the foundational educational aspect is extremely important. So, on one side of the equation, you may be seeking income. This is where you are trading covered calls. So you're capping your upside potential for an underlying security in exchange for a premium, getting that yields. Or you might be selling a cash secured put, which is still another bullish strategy, but those are neutral to bullish. Same with the credit spreads, neutral to bullish or neutral to bearish if you've got a credit call spread. So your goals, you have to know with seeking income means I have a slight directional bias, but I also might be neutral, which means we need to understand where we think the stock is going to go. And that's where technical analysis can be a layer that could enhance your option strategy. And then for your ideal income outcome for seeking income and those type of strategies is normally you want the contracts to decrease in value. You sell upfront for a upfront premium, so you're looking for higher implied volatility, or you're selling something upfront. You want to be able to buy it to close at a lower price. That's normally seeking income at a high level. Of course, not all encumbersome, but that's what you're looking for. On the other end, you're looking to gain directionally. You might be very speculative, where that's long calls and long puts, or even debit spreads, where it's an extension of a long call or a long put. You're just capping your upwards or downwards potential. So you're directional. Your ideal outcome is for those options to increase in value as much as possible. But since you're directional, we need to decide if you're bullish or bearish in both of these, but you might have a starting or a stopping point. You might need to understand if you're hitting an area of supply and area of resistance. So technical analysis can be a tool that will help you understand, should I be where I have a bullish stance in a security, for example. Am I looking to seek income or gain directionally? And that goes to your goals. Well, do you have clear conviction of how directional you want to be, or do you have a slight directional bias? And that can help determine the type of strategy that you do. In addition to that, it can also help you layer on multi-leg options. So there's lots of benefits that go along with enhancing your strategy with just another lens that is the technical view. All right. And I do like to show the Greeks whenever we talk about this, which I know is throwing something advanced to something that may not necessarily be. But if you've never attended the Greek session, I'll just give you a little overview of what this is. If you've ever seen options before, we introduce it utilizing this T chart. We put calls on the left-hand side and puts on the right-hand side. Bullish strategies are on the top and bearish strategies are on the bottom. We give you your goal. I just walked you through that with the seeking income and the gaining directionally. We're not going to go too deep into this today, but it's just where I want your mind to think when we marry options and technical analysis. The Greeks tell us the positive and negative factors of our options. The Greeks tell us how the options premium responds to different components. So if the stock goes up or down, delta tells us where the premium is going to move. Theta tells us our daily time decay. Gamma is like your acceleration, so your magnitude that's there. And vega is going to tell you your volatility exposure. So we want to amplify the positive and mitigate the negative when we're working with options. But just for the focus of today, delta tells you bullish or bearish strategies. So bullish strategies have a positive delta, bearish strategies have a negative delta. Combined, the same will apply. And that's really the focus of what we'll look at: bullish and bearish, and we'll move from there, and maybe we'll add on others. But I'll explain this, and I will not use the Greek word. So if this is throwing you off, just know that that's not what we're going to spend time on today. But if you do know the Greeks, it certainly helps with this process. So what's the value of technical analysis, and what do we want to look at? Well, first and foremost, it's the study of market data. We are in this era of so much data that's around us, and the intent of it is to recognize patterns and events via mathematical studies. All of these indicators have a mathematical study that goes behind it. It might be something like mean reversion or momentum, but the market is constantly searching for what is the price of this stock worth? And these patterns will certainly help. There is that saying that history repeats itself. I find it doesn't often repeat itself, maybe word for word or number by number. However, there's a rhyme or there is an echo. And that's what we're looking for: is how do certain stocks react during earnings season? What are these areas of supply and demand? What do those mean? What are even those words? That's what technical analysis and the value is. And that moves on to investment behavior. Areas of supply and demand is terminology that we're going to use a lot. And that just means support and resistance. And we'll draw that on some charts so you can see exactly what that means. But that's where just there are a lot of buyers and there's a lot of sellers. And we're really look at the market and functions of supply and demand. So there's demand when there's a lot of buyers, and there is supply when there is a lot of sellers. And there is investment behavior that will occur if you have a very clear area of supply where there is a lot of shares that exist. It might be something where there's investment behavior where you reach that area of supply and it becomes resistance and sells occur, because that might be where people are breaking even. And we'll show you where that is. But it's human behavior that occurs within the market. And there is a psychological aspect of that. And what you utilize is the combination of those two to identify and analyze future price. You want to figure out where the potential direction of the security is, identify the next area of supply and demand, understand the strength of it, momentum, any bearish or bullish divergence, the strength of the trend. There's so much that goes into that, but that's together, it really creates the value of technical analysis. There's so many indicators, but they fall in different categories, and we'll walk you through some of that today. So, basic assumptions of technical analysis. This is the framework that technical analysis is built on. First and foremost is markets are forward-looking. They discount information, they discount everything. and the market immediately reacts as new information comes to light. Today, the market is rather flat. We're waiting for new information to come to light, which is the FOMC decision and then subsequently Powell's speech. And once that occurs, we're going to immediately see a lot of market reaction that's going to take in that new news and then adjust the price accordingly. And the same thing happens with earnings, or when we have an NVIDIA event or any type of news. That's where the markets immediately react to news. And the assumptions of technical analysis is that the fundamentals are driving the market, and the technical analysis is going to normalize it. And we take out the noise, or we look at the patterns and trends that are there, which leads to the second point, where prices tend to move in trends. They're observable and the trend is in motion until something else otherwise suggests, much like Newton's law, an object in motion remains in motion until something intervenes. We feel the same way about the trend. The trend is your friend. It's there until evidence suggests otherwise. So an extremely disciplined component of technical analysis that we have to keep within our minds. And then history often repeats itself. Like I said, maybe not word for word or number for number, but there's certainly a rhyme or an echo. We expect repetition when we see those patterns. We identify strength when we see multiple patterns, because that becomes consistency. If something happens over and over again, that's the strength of the trend. And it's really repetition based on human nature, such as fear and greed. A lot of Warren Buffett roles are even around fear and greed. So we'll utilize that in technical analysis. So these are the assumptions that we have to keep in mind when analyzing further before we get into the good stuff. Now, so when we're marrying options with this, we need to understand that trades are generating profits, not technical analysis. As then we have to take an action on our observation is what this means. Trades also can generate losses, not technical analysis. Important to keep that balance there. So when we are expecting a directional move, we expect a sharp movement, or we may expect a slightly directional bias movement. We're going to look at the magnitude. So this is what we're going to layer on when we bring on the technical analysis aspect. So we're going to look for, okay, I expect a sharp movement. How far up do I think that movement's going to go? That would be my clear resistance zone, or maybe I don't have a clear one. What strategy would be best for me to implement when I see this? And what does the risk reward look like, the probability of profit, and what does that trade example looks like? So this is the framework that we put together when we layer on technical analysis to help us decide the strategy that we're looking to deploy today, which really goes back to what I started with is you have a directional bias, you think it's going to stop at some point, or you may feel like there's no clear magnitude. So are you speculative or seeking income is really what this comes down to. All right, so let's start with support and resistance. First and foremost, if you are ever looking at a chart, there is a very interesting saying where a different time frame will paint a very different picture. So, and this tends to be a personal preference, but there's also some rules that go with it. So within technical analysis, we are looking at the study of patterns and events and repetition. So here we have this security that's created a clear area of support and resistance. So here is our area of demand. And I like to think of it as a mattress. It's something that you sink into, and do you bounce off of that? So meaning it could be zones that are price points. So not clearly just 40, but it might be 40 to this line right here, 40, 50. So there's an area where it's a clear point of support. And there's strength in the trend when there are multiple tests and it stays true. So this is what we say by patterns and recognition. It is formed with 2, and then it is very, and you'll even see that with when we're talking about CPI data, three consistent data points equals a trend. That's something that we look at. But now what's interesting with technical analysis, and it's just looking at the support part, is when you pull a chart, you can have a chart with different intervals. So in this example, this might be weekly intervals where every candle represents 1 week. And that means this period could be over 2 to 3 years. So that's a longer term trend that we'd be looking at for support and resistance. Whereas you might have daily intervals, you might see a similar picture, but you've got more candles, as in instead of one candle representing a week, it'd represent one day. And you might be zooming into a 1 year time frame. So you might zoom in here and you see there's an area of support and resistance. And then you can make that bigger or even go into the hourly or 15-minute, but the time frame is really going to change the picture drastically. But strength is always in bigger time frames because that is larger price points, a larger data set. If you have a larger data set with mathematics, then you have a better probability of being correct because there is more data that you're testing. So it's important to take in consideration when you're looking at technical analysis. And this is from the view of the long term, of course. So we have an area of clear support right here identified. We would assume that as the security goes down, that it immediately would go up. So like a floor bouncing or from, excuse me, like a ball bouncing from floor to ceiling, just consistently does this. And we would assume that this trend is in motion until something suggests otherwise, which is it'd break above this. Then that would say range is no longer completed or the range is done. So that's where the trend in motion remains in motion until evidence is given otherwise. So therefore, utilizing this pattern, we would simply areas of support and resistance. So support is the bottom. That's your area of demand. A lot of buyers come in. This is your area of supply, which becomes an area of resistance. And this is also where that psychological aspect comes in. If you think about this, if this is over a 3-year time frame, this means that a lot of price points were hit here, and there are cells that just send it all the way down. So that's area of supply that's being reached. I might have held on to this security for this long, thinking it will break out. And when it finally makes it back up, psychologically, traders or investors may sell because they'll be breaking even. And that's what we mean by the psychological aspect is you might have held on to this for a year. It finally got back up to your purchase price and you say, you know what, I want to get out of it. So that's the psychological aspect that drives technical analysis. And that's why we call it an area of supply. It means a lot of people hold positions at that price point. That's literally what it means. And so the question becomes, will demand overcome supply? And that's when we layer on other things. But from purely a trading perspective, the way that you'd utilize clear areas of support and resistance or supply and demand is directional plays. We have a clear indication of just through this one piece that there's bullish momentum to here, bearish, bullish, bearish. We've got direction and we have a stopping point, which means if we have a clear sense of direction and a target price, clear magnitude, that's where we could do a debit spread. You'd buy something here, sell something here, as in a bull call spread. This would be your long option, your short option, because you don't think it's going to go any higher than that. You sell your option here, you reduce the cost of your long option. That's the give. The take is you cap your upwards potential, but you're okay with that because you say that's a clear point of resistance. I don't think it's going to go beyond that. And if it does, I'm okay accepting that capped gain potential. And then, of course, the inverse could be true here. So this is our clear downwards directional play. Would say, okay, well, now it reached its area of resistance. It did not overcome that. The trend is still remaining in motion. I'll buy my put here, sell my put here. I'm reducing the cost of it. I'm creating a risk versus reward structure. And so the give is reduction of cost of the put, but the take is I'm capping my downwards potential. I'm not going to make any more money on it if it continues to decline. But I think there is a clear stopping point based on the area of support. So that's why we would identify support and resistance and utilize it to go over to trading. Now, where we've got a bounce off of support and resistance and we don't have a clear magnitude or stopping point, then that's where credit spreads could come into play, where this may have a clear area of support, but this line right here would have been everywhere. It might be even getting closer and closer, which is another type of trend. But that's where we'd say we have a slight directional bias, but we're not sure of the magnitude of it. So then that's where a credit spread may come into play or a short option with different risk components that are attached to it. To know that I am speaking at a high level, but that's how we would utilize technical analysis and the basic crux of it to bring it together. And this is the first thing you learn within technical analysis is support and resistance, clear areas of supply and demand. All right, moving on. So let's talk about breakouts and breakdowns. So hopefully you recognize this right away from the previous discussion that we had. This was considered an area of resistance. It was tested here. Again, here it failed, but then it broke above. And that's what we call a breakout. So our trend is in motion until evidence suggests otherwise. This is our evidence suggesting otherwise. The way that candles work is they are for your interval selected. So if this was for a day, you've the wick, the long portion is the range for the day. If it is green, it means that it closed higher than it opened. So that means on this one, this is where it opened and it closed higher right above my resistance zone. If it was red, it means it opened higher than where it closed. So it was a down day. That's what those indications mean for those candles. And I apologize, I didn't explain that earlier. Meaning, to see a breakout, especially when you've got wicks like this, because you even notice this here, these wicks go above these areas of resistance. You want to see a close above those areas that you identify. And I clearly see a close with this green candle. So I want to make sure that I clarify that. So when I see that close, meaning that that trend was sustained, and then I've got a couple other candles, and these may be weeks or days, it depends on your intervals that you select, but know that the longer time frame is a stronger trend, but you want to look at longer and shorter trend, and that's why options have expirations. We can also throw that together as well. But now we don't have a clear stopping point. This is a new trend. We could add some other layers. There's other technical analysis that we can do to understand where it may go. But at this point, the sky may be the limit. So that might make sense to buy a long call here. And in some instances, this is where you've got to make some decisions and you need to layer on other aspects within tech than just technical analysis to your strategy here. But meaning there is no clear directional move upwards. We don't know how high it's going to be, but a lot of time there's talks about securities that are making higher highs and higher highs. And where is that momentum coming from? Or I don't want to go ahead and buy it at the high. Well, if you have conviction that it's breaking a trend, this is a signal to look at other things when we see a breakout or a breakdown. It is a signal because there are different types of indicators that you can utilize to verify your investment thesis that you see from here. So, but the crux of this, if you see a breakout, so out of the trend, that there is no magnitude, it's might be okay to sell a bull put spread here where you're profitable as long as the security stays exactly where it is or right above, or a long call where you have the sky is the limit. One has higher probability of success than the other, and there is different risk versus reward. And if there's a breakdown, then the inverse is true. It's just the inverse side. All right. I'm gonna skip the other patterns, but there are patterns that you can see that will give you reversals and continuation, but I don't have a picture of that, which I find it difficult to educate on. But I do want to make sure I at least show you, if you are familiar with technical analysis, about the different types of patterns that you can see that will give you an identification if you have a clear directional bias or magnitude as well. All right, so talking about moving averages. Moving averages can be utilized for a lot of different reasons. One, we look at it for trend. And it really depends on your time frame that you look at, and again, the type of chart. So my personal chart preference is normally a 2 to 3 year time frame, and I look at 13, 26, and 40 weekly moving averages, because 13 weekly moving average, that is 1 quarter of prices, 26 is 2 quarters, and 40 is 3 quarters. And so it's a fundamental way or technical way to look at the fundamentals, if you will, because we look at the market quarterly. And what a moving average is it's giving me an indication of the price movement. And so with that layer of a 13, so say this was a 26 moving average, this would tell me for 2 quarters worth of prices, the stock is moving up. Their moving average is moving up. And that gives me an indication that something is occurring, that if the stock is moving up from a quarterly view, then I want to see 1, 2, and 3/4 worth of rolling prices is what that means. Commonly, you'll hear the 200-day, the 50-day, the 200-week as well, the 50-week, and the 20. Those are all very common to use as well. But a moving average can also be utilized as areas of supply and demand, that mean reversion, where that's where the security will eventually end up if it moves too far, too fast, or too low, too fast, which we'll use some other indicators to identify. It can also be used to identify the trend. So you look at the slope of the line in addition to where the stock is. So slope of the line sloping upwards, this is a bullish trend. This acts as an area of support as well. So it stopped here, but however, the next day it opened and that's bad. So now the line flattened and then it begins to slope downwards. So now this is clearly a downwards trend, just looking at the moving average. And then there is an indication that this is resistance because it couldn't overcome that moving average. So now we have lower and lower and lower prices. And so this is a moving target of support and resistance. This is still acting as resistance, but now it begins to flatten. And that's my indication of a trend reversal because we want the prices to be moving upwards. All it means is higher and higher prices. There's more data going into that moving average that is higher prices. The line will begin to slope upwards. It's the math behind it. Acts as an area of resistance. It's overcome. Now that's support. And then this is a clear upwards trend, flattening again. There's some concern. So you can see how you'd look at the slope of the line in addition to the security's position to understand where the stock is going to move. And then you can also layer on top of this more the support and resistance that you'd identify. So we might even take this area here, but that's one way to look at a trend. And there is another way to look at a trend. It's one of the first pieces of technical analysis I was taught over a decade ago is a trend, yes, is downwards prices when we're looking for bullish or bearish trends, but it's a series of lower highs, indicates a downwards trend, and lower lows. So when you're looking to buck a trend, you have to overcome the series of lower highs or lower lows. And then the inverse is also true. So if this is a lower high, 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 I would want, and see how there was a clear area. We could draw a straight line here, a clear area of almost support there. That would have, don't want to get out of that, but that came support right here because I needed to overcome the last lower high in this one here that was the downtrend or the first lower high. So that is an indication of trend movement as well. So once I've overcome my lower highs and now I start making higher highs and lower lows, that's also an indication of a trend, but you want to overcome those previous areas to have validation of that trend. So moving averages is a very simple way to do that because the math, like I said, brings all of those together. Simple moving average might be something that you see very commonly. If you see an EMA, which is an exponential moving average, that just means instead of mathematically making the weight evenly distributed, it puts more weight on recent prices. So sometimes that's used for trend reversals, and that's actually what's found in the indicator MACD, which is how I personally like to utilize it. But nonetheless, this gives you crossovers are an indication of clear direction, but it doesn't give you magnitude. So we can add another layer that will certainly help with that. And again, the time frame really adjusts the picture. So let's add on Bollinger Bands. Now, Bollinger Bands, what they do is they use a moving average. That's the first part. Usually the default period is 20. So if we're looking at 20 intervals or 20 periods, so you might have a 20-day or a 20-week. Again, it depends on the type of chart and the longer time frame that you're looking at. It takes that moving average and these bands form representing two standard deviations. So whereas the standard movements within this interval, and that indicates price movement. So what that means is widening Bollinger Bands. So like here, see how these widen? indicates volatility, which is large price movement. Volatility, high beta, high movement, larger deviations. That's makes sense, right? And then when they're pinching, that indicates that there's less volatility or consolidation normally occurs because there's less price movement within those areas. And pinching sometimes means trend reversal. And that goes back to the Dow theory where areas of consolidation occur prior to a trend movement. But the Bollinger Bands are used in a lot of different ways. So I'll give you all of them and then personal preferences as well. First and foremost is areas of support and resistance. I find that that works well within shorter type of time frames. So this acts as a clear area of resistance. So you're starting and stopping points, and you can see where layering on the moving average, this is its stopping point. It crossed below the moving average. This right here indicates strength of the trend, wasn't able to overcome it, was. So you can see how this also can act as areas of support and resistance as well. Now, my personal preference is strength of the trend as Bollinger Bands that are hugging the side. So if you think about the math of this, this is standard deviations. Is the underlying security that we're analyzing hanging out at the low end of the prices that are found there? Or is it hanging out at the high end of the prices that are found there? If it's hanging out at the low end, that indicates strength. But the moment it starts deviating, then that is an indication of trend reversal. So here is a great example. And if we pull even the NASDAQ 100, I remember July of last year, it started not hugging the Bollinger Bands for a weekly time frame. And that means that when the security is making higher and higher and higher prices, the strength of the trend. So this Bollinger Bands can give you trend strength. It's a little bit of a tongue twister there. As soon as that deviates from the trend strength, deviates from the trend strength, then that's an indication that there's a reversal of some sort. And so I want oftentimes when I think it might be a mishap when this is used for support and resistance because it may end up hugging it quite constantly because of trend strength. But I find that occurs more likely on those longer time frames or weekly intervals, and then could be used for support and resistance in something like daily intervals. And again, that goes to the math and the data sets that are included. Larger data sets versus smaller is the way that I like to frame my mind around that. But other indications of how you could then layer everything together utilizing these different types of indicators. Okay, moving on, MACD and RSI and stochastics. So these tend to be indications of trend reversals. So those are momentum oscillators that will tell us if something is overbought and or oversold. And these use different types of math behind it. A lot of them use EMAs and price movements, but then it's normalized to be on a scale from 0 to 100. That's most of them altogether, especially with RSI, for example. So if we've got here on 80/20, sometimes you might see 70/30. That's mentioned on the street quite a lot with RSI and overbought and oversold. You would look for indications of did this move too far, too fast? And then crossovers with something like the MACD signal line will give you an indication, since they use that EMA, which that forward-looking prices, that something potentially better might be happen. Meaning, if something crosses the bottom line here, the 20, that means it's oversold. It's reaching in that oversold territory. However, it could be confirmation of trend. But once a signal line crosses, then that's indication that, okay, it's oversold. Now buyers are coming in. It's creating a base and this area of supply is forming. This might be an indication of clear direction, unsure of the magnitude, but that's an indication of types of trend reversals. So here, when we reach overbought or oversold territories, is really what that is designed for, or how you would utilize that. I personally like to use them for bullish or bearish divergence. I don't have example with this indicator, but certainly happy to bring that up. Okay, so I feel like we really flew through that, but always do when we're having fun. But that's the basics of technical analysis that we wanted to cover today. Those are normally the first indicators that you learn is Bollinger Bands and moving averages and how to spot a trend. But the intent of today was just to show you how you could utilize technical analysis and then marry it to your current strategy to perhaps even enhance your current strategy, because when we add knowledge, it can certainly open up possibilities, but you've got to take the time to certainly understand. So I'll look at the Q&A real quick, see if we have any questions. There will be a video recording of this webinar. I believe they send it out afterwards, or it might be on YouTube. That is for First Trade to answer. And on First Trade's website, we do have options play embedded in there. And the way that options play is set up is we don't like to overcomplicate and we like to simplify, meaning you'll see clearly on the security that you select, 3-month and the 6-month trend, it will be red, yellow, or green. Green just indicates bullish, yellow, neutral, and red, bearish. And that's the way that we simplify that on the First Trade platform. And you can find that under the options play wizard on First Trade. Okay. Well, looks like everything was answered. So I appreciate everyone taking the time today. Best investment that you can make is in your education and in yourself. So everyone give yourself a pat on the back for that, and really look forward to our next session. Thank you, everyone, and have a wonderful day.